I'm Dr.V.Subhamathi, working as an Associate Professor, Department of Management Studies, Bharat Institute of Higher Education and Research. Course code P20Mbec28 Subject name Financial Framework and Systems. Unit 1 Introduction to Financial System. Meaning of financial services. In general, all types of activities which are of a financial nature could be brought under the term financial services. The term financial services in a broad sense meaning mobilization and allocating savings, thus includes all activities involved in the transformation of savings into investment. Financial services can also be called financial intermediation. Financial intermediation is a process by which funds are mobilizing from a large number of savers and make them available to all those who are in need of it, and particularly to corporate customers. Thus, financial services sector is a key area and it is very vital for industrial developments. A well-developed financial service industry is absolutely necessary to mobilize the savings and to allocate them to various invest-able to channels and thereby to promote industrial development in a country. Classification of financial services industry. The financial intermediation in India can be traditionally classified into two: capital market intermediary, money market intermediary. The capital market intermediary consists of term lending institutions and investing institutions which mainly provide long-term funds. On the other hand, money market consists of commercial banks, cooperative banks and other agencies which supply only short-term funds. Hence, the term financial services industry includes all kinds of organizations which intermediate and facilitate financial transactions of both individual and corporate customers. Scope of financial services. Financial services covers a wide range of activities. They can be broadly classified into, namely, traditional activities, modern activities. Traditional activities. Traditionally, the financial intermediaries have been rendering a wide range of services encompassing both the capital and money market activities. They can be again classified into two heads: fund-based activities and non-fund-based activities. Fund-based activities. The services which come under fund-based activities are the following: underwriting or investment in shares, debentures, bonds, etc. of new issues, primary market activities. Dealing in secondary market activities. Participating in money market instruments like commercial papers, certificate of deposits, treasury bills, discounting of bills, etc. Involving in equipment leasing, hire purchase, venture capital, seed capital, dealing in foreign exchange market activities, and non-fund based activities. Financial intermediaries provide services on the basis of non-fund activities also. This can be called fee-based activities. Today's customers, whether individuals or corporate, are not satisfied with the mere provision of finance. They expect more from financial services companies. Hence, a wide variety of services are being provided under this head. They include managing die capital issue, that is, management of pre-issue and post-issue activities relating to the capital issue in accordance with the SEBI guidelines and thus enabling the promoters to market their issues. making arrangements for the placement of capital and debt instruments with investment institutions, arrangement of funds from financial institutions for the client's project cost or his working capital requirements, assisting in the process of getting all government and other clearances. Modern activities. Beside the above traditional services, the financial intermediaries render innumerable services in recent times. Most of them are in the nature of non-based activities. In view of the importance, these activities have been in brief under the head New Financial Products and Services. However, some of the modern services provided by them are given in brief here and there. Rendering project advisory services right from the preparation of the project report till the raising of funds for starting the project with necessary government approvals. Planning for mergers and acquisitions and assisting for the smooth carry out. Guiding corporate customers in capital restructuring. Activities as trustees to the debenture holders. Recommending suitable changes in the management structure and management styles with a view to achieving better results. Structuring the financial collaborations, joint venture by identifying suitable joint venture partners and preparing joint venture agreements. Rehabilitating and restructuring sick companies through appropriate scheme of reconstruction and facilitating the implementation of the scheme. Hedging of risk due to exchange rate risk, interest rate risk, economic risk and political risk by using swaps and other derivative products. Managing in portfolio of large public sector corporations. Undertaking risk management services like insurance services, buyback options, etc. Advising the clients on the questions of selecting the best sources of funds, taking into consideration the quantum of funds required, their cost, lending period, etc. Guiding the clients in the minimization of cost of debt and in the determination of the optimum debt equity mix. Undertaking services relating to the capital market such as clearing services, registration and transfers, safe custody of securities, collection of income on securities. Promoting credit rating agencies for the purpose of rating companies which want to go public by the issue of debt instrument. Sources of revenue. There are two categories of sources of income for a financial service company, namely fund-based and fee-based income. Fund-based income. So previously we were discussed about the fund-based activities. Here we are discussing fund-based income. Fund-based income comes mainly from the interest spread, the difference between the interest earned and interest paid. Lease rentals, income from investments in capital market and real estate. On the other hand, fee-based income has its sources in merchant banking, advisory services, custodial services, loan syndications, etc. In fact, a major part of the income is earned through fund-based activities. At the same time, it involves a large share of expenditure also in the form of interest and brokerage. In recent times, a number of private financial companies have started accepting deposits by offering a very high rate of interest. When the cost of deposit sources goes up, till ending rate should also go up. It means that such companies have to compromise the quality of its investment. Fee-based income. Fee-based income, on the other hand, does not involve much risk, but it requires a lot of expertise on the part of financial company to offer such fee-based services. Causes for financial services innovation. Financial intermediaries have to perform the task of financial innovations to meet the dynamically changing needs of the economy and to help the investors cope with increasingly volatile and uncertain marketplace. There is dire necessity for the financial intermediaries to go for innovation due to the following reasons. First one, low profitability. The profitability of the major financial institutions, namely the banks, have been very much affected in recent times. There is a decline in the profitability of traditional banking products. So they have been compelled to seek out new products which may fetch high returns. Keen competition. The entry of many financial institutions in the financial sector has led to severe competitions among them. This keen competition has paved the way for the entry of varied nature of innovative financial products, so to meet the varied requirements of the investors. Economic liberalization. Reform of the financial sector constitutes the most important component of India's program towards economic liberalization. The recent economic liberalization measures have opened the door for foreign competitors to enter into our domestic market. Deregulation in the form of elimination of exchange controls and interest rate ceiling have made the market more competitive. Innovation has become a must for survival. Improved communication technology. The communication technology has become so advanced that even the world issuers can be linked with the investors in the global financial market without any difficulty by means of offering so many options and opportunities. Customer services. Nowadays, the customer expectations are very great. They want newer products at lower cost, at lower credit risk, to replace the existing one to meet his increased customer sophistication. The financial intermediaries are constantly undertaking research in order to invent a new product which may suit to the requirement of the investing public. Global impact. Many of the providers and users of capital have changed their roles all over the world. Financial institutions have come out of their traditional approach and they are ready to assume more credit risk. Investors' awareness. With a growing awareness amongst the investing public, there has been a distinct shift from investing the savings in physical assets like gold, silver, land, etc., to financial assets like shares, debentures, mutual funds, etc. Again, within a financial assets, they go from risk-free bank deposits and risky investment in shares. To meet the growing awareness of the public, innovation has become the need of the hour. New financial products and services. In these days of complex finances, people expect a financial services company to play a very dynamic role, not only as a provider of finance but also as a departmental store of finance. With the opening of the economy to multinationals, the free market concept has assumed much significance. As a result, the clients, both corporate and individuals, are exposed to the phenomena of volatility and uncertainty, and hence they expect the financial services company to innovate new products and services so as to meet their varied requirements. As a result of innovation, new instruments and new products are emerging in the capital market. The capital market and the money market are getting widened and deepened. Moreover, there has been a structured change in the international capital market with the emergence of new products and innovations techniques of operations in the capital market. Many financial intermediaries, including banks, have already started expanding their activities in the financial services sector by offering a variety of new products. As in the result, sophistication and innovations have appeared in the arena of financial intermediation. Some of them are broadly explained hereunder. First one, merchant banking. A merchant banker is a financial intermediary who helps to transfer the capital from those who possesses it to those who need it. Merchant banking includes a wide range of activities such as management of customer securities, portfolio management, project counseling and appraisal, underwriting of shares and debentures, loan syndication, acting as a broker for the refund orders, handling interest and dividend warrants, etc. Thus, a merchant banker renders a host of services to corporate and thus promotes industrial development in the country. Loan syndication. This is more or less similar to consortium financing, but this work is taken up by the merchant banker as a lead manager. It refers to loan arranged by a bank called lead manager for a borrower who is usually large corporate customers or a government department. It also enables the members of the syndicate to share the credit risk associated with a particular loan among themselves. Leasing. A lease is an agreement under which a company or a firm acquire a right to make use of capital asset like machinery on payment of a prescribed fee called rental charges. In countries like USA, the UK and Japan, equipment leasing is very popular and nearly 25% of the plant and equipment is being financed by leasing companies. In India, also many financial companies have started equipment leasing business. Mutual funds. A mutual fund refers to a fund raised by financial service company by pooling the savings of the public. It is invested in a diversified portfolio with a view to spreading and minimizing the risk. The funds provides investment avenues for small investors who cannot participate in the equities of big companies. It ensures low risk, steady returns, high liquidity, and better capitalizations in the long run. Factoring. Factoring refers to the processes of managing the sales registers of a client by a financial service company. The entire responsibility of collecting the book debts passes on to the factor. Forfeiting. Forfeiting is a technique by which a forfeiter financing agency discounts an export bill and pays ready cash to the exporter who can concentrate on the export from without bothering about collection of export bills. Venture capital. A venture capital is another method of financing in form of equity participation. Custodial services. Under this, a financial intermediary mainly provides services to clients for a prescribed fee, like safekeeping of financial securities and collection of interest and dividends. Corporate advisory services. Financial intermediaries, particularly banks, have set up the specialized branches for this. As the new avenues of financial like euro loans, GDRs, etc. are available to corporate customers, this service is of immense help to the customers. Securitization. Securitization is a technique whereby a financial company converts its illiquid, non-negotiable and high-value financial assets into securities of small value which are made tradable and transferable. Derivative securities. A derivative security is a security whose value depends upon the values of other basic variable backing the security. In most cases, these variables are nothing but the prices of traded securities. New products in forex markets. This is very important. New products have also emerged in the forex markets of developed countries. Some of these products are yet to make full entry in Indian markets. Among them, let us see very important concept. First one, forward contract. A forward transaction is one where the delivery of foreign currency takes place at a specified future date for a specified price. It may have a fixed or flexible maturity date. So forward transactions means here delivery of foreign currency. So here delivery of foreign currency but in the future date period for the future some specified price. So future we are going to buy or we are going to receive the foreign currency at a some specified price. Maybe that price may be the fixed one for that date only. So it may have the fixed and flexible maturity date. Date may vary but prices will not vary. That is called as forward contract. Next one is options. As the very name implied that contract wherein the buyer of options has a right to buy or sell a fixed amount of currency against another currency at a fixed rate on the future date according to his options. Options means is just nothing but buy or sell. Just buy or sell a some fixed amount of currency against the another currency at the fixed rate and fixed date. So it's like a forward transaction. So here we are fixing the some rate and some date against for some currency. So it's just we are selling and buying the currency but currencies at a fixed rate on future date according to his options. That is called as options. Next one is futures. It is a contract wherein there is an agreement to buy or sell a stated quantity of foreign currency at a future date at a price agreed to between the parties on the stated exchange. So this is a one type of contract. There is an agreement to buy or sell a stated quantity of foreign currency. So here they are fixing the some quantity of foreign currencies for the future date at the specified price. So if maybe this is the June 4th or June 10th. So June 4th I am deciding that I am going to sell the some quantity of the foreign currencies to the some Y on the date of June 10th. So that is the future date. The price is also I am fixing here. So that is called as futures. Next one is swaps. A swap refers to a transaction wherein a financial intermediary buys and sells a specified foreign currency simultaneously for different maturity periods. So earlier we were discussed about options or what is that forward contract and all. So this is maybe that maturity period may be the fixed one in some situations, but in the swap definitely they are going to buy and sell the some specified foreign currency simultaneously with different maturity dates. So they are going to sell or buy but maturity dates are differs. That is called as swaps. These four things are very important. New products in forex market. So foreign exchange market, forward contract, options, futures, swaps. So next one, lines of credit. It is an innovative funding mechanism for the import of goods and services on deferred payment terms. LOC, lines of credit, is an arrangement of financing institutions of one country with another to support the export of goods and services to enable the importer to import on deferred payment terms. So this is the one kind of innovative funding mechanisms to import the goods and services on the basis of deferred payment. So here LOC is mainly arranged by the financial institution. So one country with another to support the export. So another country in the position to exporting their goods and services to our country, we are in the position to import. So for the import, lines of credit is helping in the way of funding. So this is the lines of credit. Challenges facing the financial service sector. Though financial service sector is growing very fast, it has its own set of problems and challenges. The financial sector has to face many challenges in its attempt to fulfill the ever-growing financial demands of the company. Some of the important challenges are briefly explained here and there. Lack of qualified personnel. The financial service sector is fully geared to the task of financial creativity. However, this sector has to face many challenges. The dearth of qualified and trained personnel is an important impediment in its growth. Second one, lack of investors' awareness. The introduction of new financial products and instruments will be of no use unless the investors is aware of the advantages and uses of the new and innovative products and instruments. Lack of transparency. The whole financial system is undergoing a phenomenal change in accordance with the requirements of the national global environments. It is high time that this sector gave up their orthodox attitude of keeping accounts in a highly secret manner. A lack of specialization. In the Indian sense, each financial intermediary seems to deal in a different financial services lines without specializing in one or two areas. In other countries, FI specializes in one or two areas only and provide expert services. Lack of recent data. Most of the financial institutions do not spend more on research. It is very vital that one should build up a proper data based on the basis of which one could embark upon financial creativity. Lack of efficient risk management system. With the opening of an economy to multinational and exposure of Indian companies to international competition, much importance is given to foreign portfolios flows. It involves the utilization of multi-currency transaction which exposes the client to exchange rate risk, interest rate risk and economic and political risk. The above challenges are likely to increase the number with the growing requirements of the customers. The financial service sector should rise up to occasion to meet these challenges by adopting new instruments and innovative means of financing so that it could play a very dynamic role in the economy. Present scenario. The Indian economy is in the process of rapid transformation. Reforms that taking place in every field or part of the economy. Hence, the financial service sector is also witnessing changes. The present scenario can be explained in the following terms. Conservatism to dynamism. The main objective of the financial sector reforms is to promote the efficient, competitive and diversified financial systems in the country. This is very essential to raise the allocate efficiency of available savings, increase the return on investment and thus to promote the accelerated growth of economy as a whole. At present, numerous new financial institutions have started functioning with a view to extending multifarious services to the investing public in the area of financial services. Emerging of primary equity market. The capital market, which very sluggish, have become a very popular source of rising finance. The number of stock exchanges in the country has gone up from 9 to 980 to 22 to 1994. After the lowering of bank interest, the capital market have become a very popular mode of channelizing the savings of medium class people. Concept of credit rating. The investment decision of the investors have been based on the factors like name recognition of the company, operations of the group, market sentiments, reputation of the promoters, etc. Now, grading from an independent agency would help the investors in his portfolio management, and thus equity grading is going to play a significant role in investment decision making. Process of globalization. The process of globalization has paved the way for the entry of innovative and sophisticated products into our country. Since the government is very keen in removing all obstacles that stand in the way of inflow of foreign capital, the potentialities for the introduction of innovative international financial products in India are very great. Moreover, our country is likely to enter the full convertibility era soon. Process of liberalization. Our government has initiated many steps to reform the financial service industry. The government has already switched over to free pricing of issues. The interests have been deregulated. The private sector has been permitted to participate in banking and mutual funds, and public sector undertakings are being privatized. SEBI has liberalized many stringent conditions so as to boost the capital and money market instruments. Once again, I want to thank Bharat Institute of Higher Education and Research. Thank you.